Welcome to Mortgage Sales Playbook. I'm Pat Sherlock, your host. My podcasts are where top producers, sales leaders, and industry experts share strategies that drive real sales success. No fluff, just actionable insights to help you master the art of selling and leading. Today, we're going to talk about market volatility and maintaining profitability. I have the perfect expert, Jeff Scheuren. Jeff is an expert and brilliant, explains it better than anybody I know in mortgage banking, about the capital market sites in the real world of managing a lender. He is president and chief operating officer at Fulton Mortgage Company, a division of Fulton Bank. Hi, Jeff.
Hey, good afternoon, Pat. How are you?
This is, as I mentioned, I asked you months ago, and now we're coming to really volatility and really a day-to-day thrill, to say the least. And so I wanted to open up to hear kind of your general thoughts. As you mentioned in our brief, talk, that you've seen this before. So talk about in the big picture about that, and then we'll get down to how can a lender be profitable during these really uncertain times.
Yeah, so I don't know if I've seen this particular market before, but certainly volatility in the markets over my career.
Sure.
Some of the most extreme ones I've seen, are in 2003, coming out of the '02 refi boom, and then, of course, the financial crisis, Fannie Mae and Freddie Mac going into receivership. There are all kinds of challenges when it comes to hedging a pipeline that, can make protecting the profitability on every loan a big challenge. So I am empathetic to all the secondary marketing heads out there who are probably going through quite a bit of emotion these past couple of days. I've been there, right? So I feel you. Yeah, this is unprecedented, Pat. I wondered how much we could really talk about, because you almost have to throw economics 101 out the window a little bit, right? Because the
Sure.
market is trading on fear and uncertainty opposed to fundamentals, because the fundamentals have to be reset. I mean, until that's known, it doesn't know what to do. It's looking for direction. So everything's being driven by headlines, and it's difficult.
Well, it was interesting. One of the comments, and as an ex capital markets person myself,
Mhm.
one of the golden rules of thumb is that the US Treasuries are a safe haven.
Mhm.
And that's always been the case. And even when we've had some difficult markets, this has always still been our wonderful viability of our financial markets, is that the US Treasury has been a safe haven. But
Mhm.
certainly there is now, and what you're seeing with the treasuries is that they're not operating in the way that we've expected, and certainly, or what they have in the past. And the question about whether they are a safe haven really comes into play. So I'd like to hear your thoughts on that, and then tie that together with the wonderful world of our housing finance market, because our funding is coming off of that debt.
Mhm.
So what are your thoughts on that?
Well, so yeah, the treasuries are typically a safe haven and trade, opposite of stock markets, right? So
Sure.
we did experience that when the tariffs were introduced. Stock market sold off and the treasury yield dropped below 4%, and then it started to edge back up as markets kind of rethought, what does the tariffs truly mean for inflation and the economy in general. It's, treasuries are still a safe haven, hasn't gone away, but there's other variables that are impacting how they're trading today, right? And some of it
Hmm.
is, there's a rumor overnight, when they yields went up as quickly as they did overnight, was it because a fund had to liquidate treasuries to cover a margin call? Who knows what's going on out there? But demand for treasuries is a changing dynamic in a tariff trade war, right? So
Right.
how that shakes out is yet to be determined. So what we're seeing in the meantime is, stocks selling off and yields going up. So, which is, not what you typically see. And the 10-year yield certainly drives mortgage-backed securities and mortgage rates. That spread that has typically been in the 170 to 180 range,
Hmm.
170 to 180 basis points above the 10-year treasury, has widened, right? So it's gotten above that and it's stuck there. So does that change even more given the environment, change with the changes that are going on with Fannie Mae and Freddie Mac, with Bill Pulte in charge of FHFA?
Yeah.
There's so much going on. We just have to let it play out.
Well, talk about from your capital market standpoint, but also ahead of a mortgage company. How
Mhm.
how do you at the capital market side? my question, like, how do you hedge to this?
Mhm.
And how do you protect yourself? I mean, that's really what it comes down to.
Yeah.
And when you look at as running a lender shop, how do you, in other words, how do you maintain your margins? And
Mhm.
talk about some of your thoughts on that.
Well, a couple things. One, you just got to be watching it much more closely in this market than you
Yeah.
would otherwise. I mean, you should always be, have a good oversight of your position, but almost micromanaging, right? So
Hmm.
with this kind of volatility, the dynamics of duration change and
Right.
how the coupon price swings change and how they effectively cover, the changes in the market versus the change in your pipeline. All of it has to be watched very, very closely. So, that's why I'm empathetic to all those secondary marketing and capital markets heads out there, because I'm sure that they're
Yeah.
doing deep dives into assumptions and everything else to make sure they've got a handle on things. I remember talking to bond traders during periods of volatility. And, I've always
Mm.
said, rates are going to do what they're going to do. All we can do is, keep an eye on it, make sure we feel comfortable with our position and, change with the market. So it's just keeping up is really the name of the game.
So do you see it as something that you want to be like 100% hedged, or would that obviously should have been done beforehand? But
Yeah.
as you well know, some of these people play the market and it really is not a good strategy, but that's another story unto itself.
Yeah.
But in this market, if you haven't done anything before from a hedging standpoint, and now you're amongst this, well, how do you see that playing out?
You never want to be 100% covered. You never want
Sure.
to too uncovered, right? This is it really does come down to the fundamentals of making sure the mechanics are doing what they expected them to do. So prior to this market, there was assumptions in the hedge model that said, if the market moves 50 basis points, 100 basis
Yeah.
points, you should expect this. Well, did that happen? And if it didn't, then how are you adjusting your assumptions accordingly and as quickly as possible, right? So you're not waiting till you're 3, 4, 5 days into it. You're looking at them, from the moment you start to see volatility. Hedge ratios are going to whipsaw in this market, right? You're going to get longer because your pull through assumptions are going to get higher
Right. Mhm.
in some cases, and then vice versa as markets turn around. So it's just keeping up with it and making sure that you know everything that's going on in the dynamics of that position.
So let's put on your lender's hat
Yeah.
and let's talk about obviously how is all of this volatility and how do we manage at the Salesforce level, at our
Mhm.
customer level, all of these issues that really have people pretty much on the edge.
Well, I think for us, we give all our loan officers the tools that we can to be as informed as they can be, right? So,
Hmm.
as a lender, I want to make sure that our pipelines are protected, our customers are protected, and that our loan officers who are out there making calls and taking applications feel protected in a market that is just all over the place. So, having patience on both sides, just
Hmm.
keeping the sales force informed as much as possible, asking your loan officers and sales managers to maybe don't push too heavy on the secondary marketing desk during these stressful times, with hey, did you get my lock and make sure it's protected? All that's
Sure, sure.
important, but everybody's calling at once. So it makes it very difficult. So it's really just trying to set the expectations of good communication and making sure that everybody feels good that we're taking care of the customer at the end of the day.
So have you amped up more explaining to that internally, or is it assuming loan officers don't use the tools, which is
Mhm.
typically a lot of the case? So are you having to give more talking points because obviously you have a lot of nervous people from the consumer standpoint, in addition to the sales force. So have you had to amp that up, or is it something that it's an older workforce and they've seen this before?
Yeah, a lot of it is we've seen it before, but I think our secondary marketing department does a good job of keeping sales
Hmm.
informed, right? So, hey, here's what to expect, bleeding into just an example, there's days where economic indicators come out that are certain
Sure.
ones that create volatility, right? Non-farm payroll being one. We'll set the tone and expectation, right? So the secondary marketing will say, we expect volatility. So we might close the desk down tomorrow morning at 7:30, so we have time to fix our positions before the number comes out at 8:30,
Oh, okay.
and we open it back up. But it also communicating some expectations as you go. We just had regional meetings, where we visited the regions throughout our footprint, And
Right.
our secondary head of secondary marketing gave an update to everybody there, current marketing conditions, kind of his thoughts, what to think. And then with the tools that we give them, I think they're pretty well informed, to your point, the ones that use them, because not everybody
Sure.
does. But
Yes.
the back, the ones that use them sometimes throw it back at us too, right? Yeah. We expected rates to get
True.
better than they did this morning. That's what happened.
Good point. Yeah, good point. So, have you seen how has all of this impacted, let's say, from the volume standpoint? Are you seeing the consumers still moving forward? This is our spring season, which is in essence when we do business. Or
Yeah.
are you seeing people stay on the fence? Have you seen people's pricing at the housing component? Has that in essence come down? Or what do you see going on currently?
Yeah, I've had a chance to talk to a few realtors, and at least locally, and the sentiment is the inventory is a little higher than it was last year.
Gotcha.
But properties are moving quickly still, right? So
Mm.
there's still
Oh,
a lot of showings. They're still moving fairly fast. I do think that, people are getting used to the current interest rate environment a little more than they were a year or two ago. The psychological standpoint of a 6% interest rate is probably easier to swallow than it was last year and the year before that. So people are coming into the market and not necessarily they get to a point where they can't wait anymore, right? So they need to make decisions and they can't wait
hmm
for rates to come down. So buyers are there. In fact, where we're seeing the most growth this year, that is new construction
Okay.
and
hmm
first time home buyers. First time home buyer products are up over 150% year over year.
Oh, wow.
Yeah.
Okay. I was going to ask that question. Are those first-time home buyers able to qualify? And it sounds like
Yeah.
they are.
Yeah.
So,
We're getting a lot of qualification.
so do you also, Jeff, see, and I'm curious about the famous adjustable rate loan product, which is a way to actually protect the lender. Do you see that becoming popular, or is it still always in our fixed rate world?
I think we do a lot more adjustable rate mortgages than most. And
Mm,
that may be just because we do a good amount of jumbo rate mortgages, right? Or jumbo mortgages. They're less available on the conforming side, as
yeah.
with liquidity challenges, banks said in 2023, which is the primary driver of conforming adjustable rate mortgages, because the secondary market isn't always there for them. Um, we do a bit more. So I think there's demand for them because they give those borrowers a better intro rate. So we see more than most. I haven't seen the demand shift one way or the other.
Right. Yeah. We always think that product's going to take off.
Yeah.
It never does. It
No.
doesn't. So talk about from a profitability standpoint, because volatility obviously is looking like this is going to continue for a while. And
Mhm.
so how as a lender, as senior manager, handle the profitability side of it? Is this a time to look at your cost structures? Maybe we need to retool and right size our staff again. What are your thoughts on that?
Yeah, it's all the above. So one, making sure you've got enough priced into each loan to cover your cost to originate, right?
Sure. Mm,
Because not that isn't the case everywhere. At least my experience all
mm,
the time. You might have some loss leader products, but at the end of the day, your profit margin needs to be built in. The way to stay competitive is to get your costs down. So a couple ways to do that is technology. It's do you have the right number of staff? Is your staff as efficient as they can be? So that's what
mhm,
we're doing. We're looking at efficiency and we're looking at technology. Where we can improve the process. I hear a lot about AI, and
mhm,
I think there's good strides being made. One what we're trying to do is chatbots and using AI and chatbots and
correct.
trying to incorporate those into the process where you can really help save time. And every minute counts. So our focus right now is FAS 91 cost to originate, that whole study. I don't want to get too into that, but
Sure.
looking at every component and seeing where you can cut out of it to drive the cost down.
And so, from a staffing standpoint, with some of this new technology, do you see it impacting, in other words, less people, or we're adding more people, and then when you add volatility to it, where do you think the staffing side is going?
Well, I think you need to look at the success profile, if you will, of the employees
Hmm.
that you hire, right? So how
Sure,
digitally enabled are they? How digitally proficient are they? And how
sure,
can the managers that are on your staff, how can they start to think about ways to improve the process using technology? Not necessarily trying to dictate it from a top down perspective, but listen to the people that are in the weeds every day, giving you ideas.
sure.
Yeah.
And so when you see, and one of the trends that I see lenders doing, and I'm curious about your thoughts on it, they're moving to what I call kind of, or what people are calling a P&L model, where in
Mhm.
other words, their margin is essentially theirs, and then the margin for the loan officer is really left up to the loan officer what resources they want and what resources they don't want.
Mhm.
Is our industry going to that? Just and I definitely see a fair number of lenders, especially on the independent mortgage banker side, do it that way. So how do you kind of see that?
I think there's a place for it in every
Mhm.
lender's strategy, if you will. I think I look at that as another channel, right? So if you got a
Right.
retail channel, you got a third party channel, you got a P&L channel. Not every sales manager will adopt to that, and not every
Mhm.
sales manager who wants a P&L model will adopt to a non P&L. The more opportunities you have for salespeople who are entrepreneurial and want to drive a business
Yeah.
profitability plan or drive a P&L, to give them the opportunity to do it, it can be successful.
So what are the things, I mean, I have a million questions more to ask you, but we're
Mhm.
coming near the end. What are some of the things that, and again, this year looks like a volatility year for sure, that
Mhm.
are things that you're doing differently than what you might have done last year?
So, going back to that FAS 91 study, right, looking at
Mhm.
all of those costs, trying to just make sure we're weeding out redundancy, looking where we can replace process with technology, some managed services with a vendor that we have some components done by an offshore component with our onshore component. So helping to just drive the cost per loan down as much as we possibly can.
Yeah, this is part of our wonderful world of mortgage lending. There's never a dull moment, that's for sure. So, any thoughts or a couple thoughts for our listeners today on things that they can do or takeaways that they should have today?
Well, yeah. I mean, if I was somebody, listening to this and I'm in charge of a P&L, or if I'm in charge of a mortgage company, certainly being disciplined on pricing, right? Because you need to stay profitable. If I'm a sales manager or loan officer, be respectful of the sense that you want your company to be profitable too, right? You want the lowest rate, but at the same time, it's not helping anybody as an industry that we're losing money, right? I think there
Mhm.
were some profitable quarters last year, according to the NBA, and in the fourth quarter, it dipped into the negative again. So refinance as a strategy is not a good strategy. Waiting for that refi wave is it's not. I don't see it coming this year, Pat. That's just my opinion.
Well, it's my opinion too, but I have to say that I agree. It's a hope strategy, and that's not a good idea. So I want to thank you, Jeff, for sharing your thoughts. I have to have you come back. You do such a
Yeah,
great job
you're
with
welcome.
this, explaining. And I think we need to talk more about the FASB 91 and the cost to originate, because I don't think there's a lot of discussion of that for sure. There needs to be. And so I want to thank our listeners also. Subscribe to our podcast. We'd love to have you. So thanks again, Jeff.
Yeah, you're welcome. Thanks, Pat.
That's a wrap for this episode. Be sure to subscribe, leave a review, and share it with your team. Want more proven sales strategies? Visit patsherlock.com for expert resources, coaching, and sales training. Until next time, keep selling smarter and not harder.